Our long term is to return capital to our LPs. That is our focus. And we do that, again, by partnering with our portfolio company leaders, our founders, and helping them grow and scale it. The founder isn't necessarily thinking long term, how do I return the $6 million plus? They hopefully, and this is a question that we ask in diligence, are thinking, what's the big vision? What's the thing I want to build? One of the questions we ask every founder that we talk to is, what is your big vision? Where do you see this going? Be focused on your big goal. Be focused on that big vision. If you don't have a big enough vision, it probably isn't the right investment for us.
Welcome to the Raise and Exit podcast, where we have the privilege of talking to and learning from entrepreneurs, fundraisers, venture capitalists, private equity folks who have been on the other side of going and investing into companies or acquiring them. Today, we have the privilege of Saydeah Howard from Cherryrock Capital, who's going to be coming out of hiding to go and share with us wisdom that she's gone and gained over numerous organizations and decades of experience. So on that note, welcome. Please tell us a bit about yourself. What had you go and leave a late stage fund to launch an earlier stage fund, and just something that people might not know about you readily?
Thank you, Edgar. I appreciate that. I'm happy to be here. The impetus for leaving the late stage fund in my previous firm was IVP, Institutional Venture Partners, which is a fantastic firm. It's been around since 1980, invested in some amazing companies, was honestly seeing some of the mistakes that late stage companies make and thinking about the opportunity to help them at an earlier stage, thinking about A and B and what you could do differently before you get to an IVP type company, IVP type venture firm. The other impetus was just thinking about, frankly, founder diversity and the lack of diversity of the founders that I had an opportunity to work with, and really wanting to bring some of my skills, expertise, and experience to a group of founders that may not have had that in the past. And so that was another real impetus and drive for us to start Cherryrock Capital.
That's really helpful in terms of that context. And I think what you're pointing to is just, I think, such a critical element. The reality is of a lot of venture is really going to white young men, typically. And that's there. And there is a definite underrepresentation of both women and minorities. And we're not even going to get to women minorities into that conversation, because that's a whole other thing that's there. So thank you for sharing that wisdom. And I think you're going to be able to provide a perspective that is hopefully going to be an inspiration for more people to become founders and pursue that path, knowing that wisdom from folks such as you is there. So let's start with a bit of that wisdom from you that I think you can share. So given that you were in a later stage fund, and there's still a general impetus for a lot of earlier stage companies to realize, look, I'm going to go and have a pre-seed, a seed, a series A, a series B, etc. That's still a catalyst for how we grow businesses, even if there's a change now in AI-enabled companies being able to go through a different path, but that's not available for every single type of company. So could you share something that is important for an earlier stage company to know about that's going to make it easier for them when they grow larger and require late stage investment? What's something that they can do now to help them up for success in the future?
I don't know if it's necessarily going to make it easier, but one of the big mistakes that I see earlier stage companies make is in thinking about the growth of the team and the leaders that they hire. Every company goes through certain phases, and some might go through it relatively quickly and some might take a long time to get there. But the phases are from the early stage. It's the founder, it's the founding team, entrepreneurs that are passionate about whatever they're building. They've got a real direct connection to the problem that they're solving, the mission that they are all involved in. And then you start hiring some people to execute that. You start hiring engineering teams, you start hiring your sales folks, your go-to-market leader. And every hire that you make is a little bit further away from that original mission, passion, vision. How do you keep that? And we use the word culture, and I think that means different things to different people. But how do we keep that connectivity all the way through? How do you make sure that hire number 1,000, which happened 4 years after the company was founded or 8 years after the company was founded, understand what the problem, mission, is what we're trying to solve and is as connected and keeps that going. Founders have done that in different ways. Some founders do that by trying to keep control of everything, and every hire has to go through them and every hire has to be reviewed by them. I don't think that's sustainable when you've got 10,000 employees. Some founders choose to do that with the leaders that they hire, so their head of sales, head of marketing, head of HR, et cetera. Some founders do that with a small group of people that are culture carriers, if you will, and they vet every single hire that comes in after
Mm,
that. However you choose to approach that problem, one of the biggest issues that we see at the late stage is that shift from I'm passionate about what I joined and the startup and I love the early days to I'm just an employee here to get my 4 years of vesting, to get some equity and hopefully be rich. And you can get employees that are still just as connected, even in your later stage. But the further out that you get, the tougher it is to do that, and the tougher it is to vet for that. Thinking about that early on and setting up an organization and setting up a company that can do that, that can keep that connectivity all the way through, and that can make sure the people that you're hiring, whether it's employee number 50 or employee number 50,000, is still on board with what you're trying to build.
I love what you say there because I think a lot of the narrative around fundraising or the stages that is there is like, oh, we're raising to scale the business to the next level, right? But I think what you're actually going alluding to here is your scale relevant to your raise? And are you actually operating from that point of view of like, am I just trying to create like a 2 or 3 times larger version of ourselves right now between now and the next funding round or the exit? Or do we actually have to shift or pivot? And what I think that kind of brings me to is a follow-up question to that, which is like, what are those signals that you are looking for? And this might be going back to call it your late stage that now you might be applying to those earlier stage, right? Because you're constantly looking for companies that you're like, okay, if they hit this threshold, we want to invest, right? And now I gather you're from the other side, which is like, hey, if these guys invest, get to this threshold, there'll be others who want to come in with Series C, etc. What is that balancing act between those self-starters folks that you might want to have as a smaller company, or those ambitious, they can just give them a little bit of instruction, they run with it, etc., versus when do you need to go and start bringing in the systems people, the people that can scale teams en masse, as opposed to build them 1+1+1 that you might do in an earlier company? What are those hints that you've learned from the past couple of decades?
So I think I heard a couple different questions in there. First is just some of the things that we look at both for our investing in Cherryrock. We invest at Series A primarily, and when available, Series B. Um, and then what we look at to help our companies get to the later stage. And the short answer is it's not one particular threshold. It's not one particular metric. It's a lot of things. So in my undergrad, I went to Stanford for undergrad. I worked at the admissions office. And way back when, parents would ask, well, is it better for my kid to get an A in a regular class or a B in an AP class? And
Mm.
they would hate the answer. And the answer is an A in an AP class, right? And that's the same thing with fundraising. So we have entrepreneurs that talk to us at Series A. And Series A, I think, is a really unique space to be in. You've gotten past seed, right? You've proven that you've built a product. There's some sort of product that's happening. You've got customers that are paying for it. At Series A, we are looking for product market fit, and we are looking for growth.
Yeah.
So a lot of entrepreneurs come to us and talk about, oh, our year over year growth is 200% or whatever. That's great. That's one piece of it. What's your customer concentration? Your year over year growth can be 200%, but that's one customer that's accounting for everything. And we don't know how well you're going to do as you start to grow to other customers. Your year over year growth can be amazing, but your margin is 30%. That's not great. You're paying to get those sales. All of those metrics really come together. That the second part of your question, I think I heard, is when should companies and when should startups start thinking about moving from the early stage passionate folks that are 1+1+1 and getting it done, and the scale on mask? I think it varies. Some people like to put a revenue number on it and say when you get to 50 million, when you get to whatever. Some people put an employee number on it. After 200 employees is when you should be.
Mm.
I think it's thinking about the team that you have and the team that you've built at every stage along the way. One of the things that we've noticed already is at Series A, the two main functional needs that our portfolio companies have are head of sales, the go-to-market leader, and head of finance. And the question then is, for both of those roles, are you hiring a CFO that has had the CFO role at much larger organizations and they want to run it back and do that thing all over again from the beginning? Or are you hiring a VP of finance that's going to be great for the next 2 to 3 years? And then you hire that person that you're talking about that can scale en masse, that can build operations, the real CFO.
That's a great statement that you're going and making there, because it's the skill set versus the expertise, right? Like one of the things I've seen as an explosion is those fractional finance and fractional revenue roles that are actually oriented around startups. Like I know a bunch of fractional CFOs. They have like 3 or 4 like earlier stage, growth stage startups that they're going and advising probably like 10 to 12 hours a week, right? And like if you're there, like what do you view there as being the valuable? Is it going back to the I want to go and have somebody who's seen it all, done it all, but is available fractionally? Or would you want somebody who's there every day but more immersed in the business but has less seniority and exposure? Like what would you say is important for you as you're doing your due diligence?
For us, and we've looked at companies that have had both of those models, it's really about how does it fit into where the company is today, but more importantly, where the company wants to go. You don't want a lot of turnover on your executive leadership team. You don't want a lot of this person was there for 6 months or a year and then this person is out. I love the fractional leader when it makes sense that this person could become a full-time leader in your organization. If it's purely fractional with never an intention of bringing on board, everyone should be thinking of that as a bridge move. And a bridge move that does a couple things. That one, maybe sets up, let's use finance as the function for a moment, that sets up your finance organization in the right way, that makes sure that you've got the right applications, the right tools, that maybe starts to hire. And they can't do all of the hiring because your full-time leader is going to need to do that, but can bring some people in place to get it in order. That helps in thinking about fundraising from a strategic standpoint. And that can be a part of hiring for that full-time person. So a fractional CFO is great if they can leverage their expertise to bring on whoever your full-time leader is going to be. But that is not the long-term solve, and everyone should know that going forward. That is a short-term interim bridge to get you to where you need to be.
I love that. I love that because that almost goes into the use of funds conversation as well, right? Because you are at that inflection point, right? It doesn't make sense for you to go and have a full-time 15, 20 years plus experienced CFO as an 8-person team. But maybe as you're trying to scale to a 100-person team, okay, that's going to be one of the purposes of this use of funds for the next 18 to 24 months. That's fantastic. I love that insight that's there. So let's go and actually just add that a little bit more then as the next piece that's there. So we've talked about, like, look, you have the attitude that's there. It may not be revenue or the size of org, but when would you say that founders should be prepared to start, like, really delegating accountability as a business from the experience you've gone and seen? Where have they done it well? Where have you gone and seen that it has just hurt them years down the road?
So again, it's hard to say that there are specific breakpoints, but I can tell you from having diligenced a number of companies over the last 2 years, Series A is one of the interesting times where if you haven't moved from founder-led sales, you should be moving from founder-led sales. Right? So pre-seed and seed investors will tell you your founder, your CEO, your leader should be involved in every sale that happens. They should know exactly what the customer is buying, what they're looking for. And then Series A, again, either as you're raising it, before you raise it, or after you raise it, as when you start thinking about how do we make that transition. And maybe depending on the product or service, it's not at Series A, you're thinking about it at Series B. Regardless, it's less about when you make that transition and 100% about who you hire. Hiring that first go-to-market leader that's going to actually change your revenue trajectory from 3 million to 10 million, from 5 million to 20 million. That individual that you bring on board is so key to the success of the company. and frankly, raising that next round, founders need to put as much time, energy, focus into that hire as they do into the fundraising process, as they do into the product process, as they do into understanding what their customers are looking for. Hiring is not easy. It is time consuming. It's frustrating. It's hard to know when you're getting it right because we so often get it wrong. But for those key roles that can literally change the outcome of a company, that's where I tell founders that's where you should be spending your time. And again, I would say it's somewhere within that Series A timeframe
Mm-hmm.
that they should be moving from that stage to the next.
Um, Something in there that you said that reminds me of a little of the work that we've gone and done. When people are investing, they're investing into the founder slash leadership team. When people are acquiring, they're acquiring the company. And I
Yes.
think this goes into what is your end game through this as well. And I think what you're pointing to is, and if I can paraphrase a bunch of conversation and get your perspective on it, you're looking at it from the point of view, hey, I'm about to cut you a check for, I don't know, I'm going to make a number up, $2 million. You and your LPs are now out $2 million. How are you going to get that $2 million back? And there's one of two ways, right? You sell it several rounds down the road to a
Mm-hmm.
late stage, and you're like, yep, we're ready to leave, and they want that equity and they don't want to dilute anymore. Or you sell the business to go and get your multiple. And I actually feel a lot of founders forget what's in it for the investor because they're like, oh my
Yeah.
God, we just got a check. We just got runway for 24 months. But like, tell me a little bit about that. Like from your perspective, what's that mental gap that is maybe there for founders as to what the purpose of the investment is?
Exactly. That's a great point. So our average check size, because we're at Series A and because we like to lead rounds when we can and take board seats, we want to be active partners to our portfolio companies. So we'll write a $6 million check,
Mm.
$8 million check. Our average check size is somewhere between 6 and 8 for Series A, and then higher for Series B. And yes, you're absolutely right. When we write that $6 million check, we want that money back plus some, right?
That's exactly
Our
it.
long term is to return capital to our LPs. That is our focus, and we do that again by partnering with our portfolio company leaders, our founders, and helping them grow and scale it. In the short term, I think when we ask the question use of funds, it's often around growing, scaling, right?
Mm-hmm.
It's building out the team, it's moving the product forward, it's engineering, it's go to market. It's usually those things. The founder isn't necessarily thinking long term, how do I return the $6 million plus some, right? They hopefully, and this is a question that we ask in diligence, are thinking, what's the big vision? What's
Mm-hmm.
the thing I want to build, right? And one of the questions we ask every founder that we talk to is, what is your big vision? Where do you see this going? And that answer is not a, well, I want to IPO and I want to be ringing the bell at NASA. That's not the question. Or I want to sell for $10 billion. It's thinking about I want to be in every company doing X, Y, and Z. I
Yeah.
want to have every person on the, when you think about this space, you think about us. It's that kind of big vision. What we do at the stage that we invest in is think about, okay, if that big vision were to occur, what does that mean from a financial standpoint, right? Whether it's the market share that they've gotten of their TAM, whether it's the revenue projections that they have that we've obviously haircutted because entrepreneurs are very positive thinking people and they always think things are going to go up and to the right. And we know that's not necessarily how it works out. So we take into account the financial implications of where do they want to go? How big do they want this business to be? And then what that means for our investment. I don't know if entrepreneurs need to think about that when they take funding. I think they need to think about, and what we would say is be focused on your big goal, be focused on that big vision. And if you don't have a big enough vision, it probably isn't the right investment for us. And that's something that we've had to say is if someone says, hey, I want to build a nice lifestyle business and I want to throw off, 2 million of profit a year and I'm happy with that. That's great. You should do that. Maybe that's not a venture-backed business.
That's so
Maybe that's
good.
not
It's so good
the
what you
right
said
thing
there.
you should be looking at.
I think you just nailed another critical thing that's there. There's a spectrum of how you can go and get money. I think we have a
Yes.
romanticism about venture that may not be relevant for venture. Like going back to
Yes.
like your educational element that's there. I had the privilege of working with a bunch of universities earlier on in my career. And one of the things that we constantly found out for them is that they had too many people in their programs that shouldn't have been in university in the first place. But as a
Yes.
society, we sensationalized, oh, like you're not going to make it unless you go to university. It's like, no, you can actually really make it in trade schools or in specialty niche one-on-one training, etc. That I think people need to consider. And I think that is also an important consideration for entrepreneurs that are out there. What do you need? Right? What are you trying to raise for? Right? And to your
Yes.
point, it has to be a big enough bet because for it to, like, look, if you're cutting a $6 million check, in the back of your mind or your LP's mind, at least one of them is thinking, I want 60 million out of this thing.
Exactly.
Right?
That's exactly
Yeah.
right.
That's exactly it. So I love that. I want to shift topics a little bit because this is another part of just like, looking into your background, etc. And I love some of the perspective that you've gone and shared in the past years around just kind of managing yourself as a founder. And why you were such an espouse for talent and building strong teams. What are some, like, I don't know, questions to ask oneself that you'd recommend for entrepreneurs to know that they're really skirting the line between pushing the envelope but doing it in a responsible way versus impairing your future self and the business that you're trying to build?
I think a couple, well, so I would start with a couple different areas because I do believe that managing yourself and it starts by knowing yourself. So that's the other piece of it. I worry about leaders that aren't self-aware. And
Mm.
one of the things that we diligence on is self-awareness. And it's in a lot of different areas. Self-awareness to know these are the things I'm really good at and I should be focused on as a leader in this organization. These are the things I'm not really good at and I frankly don't like, and I should hire fantastic people that are really good at it and that like it to go do that in this organization. That's the first
Hmm.
piece of self-awareness, is just from a skills, expertise, desire perspective. I've talked to CEOs that are afraid to say, I don't know much about finance. I'm an engineer. I'm the science person, and this is what I really want to do.
Hmm.
And some that bluster their way through as they're talking to the CFO, some that just sort of nod their head and say yes to whatever their CFO is saying, and some that feel like they've got to pretend, they've got to know. It's okay to acknowledge that there are things you don't know. It's okay to say, I don't know, and then go get the knowledge, and then go hire that great person, and then use your network. One of the things that we say as a firm is it's not just about the check. And one of the reasons we want board seats is we really want to be a partner to you. So if you're a technical founder and you don't know finance, you don't know HR, we can help you with that. We can get you connected to the right finance leaders, people
Hmm.
with expertise that are more than willing to give you a brief primer on this is what it means. These are the terms. When you're interviewing CFOs, this is what good looks like. This is what great looks like. Let us help you get to great in the leader that you are going to hire so that you don't have to spend mind, energy, and time worrying about that. I think that self-awareness, that emotional regulation, I think that's the other piece. One of the things that I personally try to do, and I'm not 100% successful at it, but I try, is when I'm talking to someone, what is their motivation? What are they trying to get out of it? How do I communicate with them in a way that helps them understand what I need to happen and that motivates them in the right way to get it done?
Mm.
As a CEO startup, you might have one leader that frankly needs the stick a little bit more, that needs deadlines, that needs hards, that needs a little bit more, I hate to use the word micromanaging, but needs a little bit more hands on. And you might have another leader that does not thrive with that.
Yeah.
Another leader that just says, that's the hill, go get it. And they're off and running and they can do that. And they'll check in with you when they need to. Being a manager and being a leader that can shift to the different types of people that you work with, that can understand when someone needs more of a push, when someone needs more of a step back, when someone needs more of a gentle hand. That's part of that self-awareness that we talk about, and the ability to regulate to that. Some people
Mm.
can't. Some people only know one style. And we can think of leaders that we know of in the past that only manage with one style, and it's always the iron fist. And what they end up doing is hiring people that only respond to that.
Yeah.
And they
Oh,
don't hire people that can do different things and that respond in different ways. Really strong leaders know how to manage themselves to the point that they can manage others in different ways to get the best out of everybody on their team.
I love what you say there because there's that kind of like statement. I'm still not sold on this after decades, which is like you never want to be the smartest person in the room. And what I actually think what you're actually alluding to is you should never be the most capable person at everything your company
Yes.
needs. You want to
Yes.
go and hire for people that are more capable at a specific area. And I think we've conflated the two. So I love, Saydeah, how you just kind of distinguish that, right? Go and find people that are better at that thing. You're an engineer, find the better finance person and someone who can
Yes.
understand the engineer, not just that they're good at finance, but they can understand and not take advantage of your, hesitancy or unease about your own financial skill set. So that's fantastic.
Yes. If I were a CEO sitting around looking at my team, I would love to believe that each of the leaders that I've hired is the very best at what they do, and they're better than me at what they do. And my goal is to get them all to work together as a team so that we could get to where we need to go as a company.
And that is a transition right there as you're going from seed all the way to late stage. And what you said. My last request for you is what is a word or kind of like a guidance or phrase of encouragement that you'd go and put for minority founders or non-represented founders for how they manage themselves in raising capital? What's something you'd kind of go and put? How do you know how to either screen out early that this fund is not going to be a fit, or maybe another a word of wisdom? Because the unfortunate reality is we're not in a meritocratic world in how we operate.
I think a lot of funds really do believe that they're looking for the best deals, regardless of the founder's background, regardless of the founder's gender, ethnic background, immigrant status, etc. And they really believe, hey, we just evaluate great companies. It's all about the companies. And I agree with that, except one of those big pieces of the evaluation is the leader of the company, right?
Mm-hmm.
We aren't investing in autonomous robots just yet that run companies. We still have humans that are running companies. And when you bring humans into the mix, we all do things like, oh, they remind me of me. Oh, they went to the same school I went to. They're in my fraternity. Oh, we talked about basketball. I'm a big fan of this, and we connected. It's those connections that often make us believe what the person is saying. And that is often part of the investment decision analysis. If every venture firm simply said, give us your metrics, we plug them in to our algorithm, and then the algorithm says, invest, don't invest, that's a different story.
Mm-hmm.
If part of that algorithm includes any evaluation of the founder, of the leader of the company, then we've introduced some human element into it. And that introduction of human element may or may not introduce some bias, or it may or may not introduce some element of benefit of the doubt, right? And I've seen this happen real time where one entrepreneur gets the benefit of the doubt that their modeling and their projection for their sales for the next 5 years is 100% right. And another entrepreneur gets the skepticism that they're being too optimistic, that they're never going to hit those revenue numbers. And the difference might be the ethnic background. The difference might be the gender. The difference might be the school that they went
Yeah.
to. This entrepreneur went to a state school. This entrepreneur went to Stanford. How do we think about that as investors? And so for us, one of the areas that we truly believe is an area for investment are entrepreneurs that may not get the benefit of the doubt from other places, but they get that from us, right? And we talk about investing in underinvested folks. If you look at where 99% of venture dollars go, we think about that 1% and understand that there are great companies great entrepreneurs in that 1% that we want to dig deeper on, that we want to then look at the metrics and make all of the positive assumptions, if you will, that may not be getting there with others. So to answer your question directly, what advice would I give to underinvested founders? There are people that are out there looking for them. There are people that are out there that are looking for great companies and that are using some of the same metrics, et cetera. But when it comes to the founder themselves, they are very much open to what non-traditional backgrounds, right? They're very much open to people that don't necessarily go to the same schools or aren't necessarily uh, building connections in the same way. And I'd say Cherryrock is one of them. There are tons of other firms out there. And it's about the individual that's going to invest in your company. So there are lots of traditional venture firms that have individuals that say, hey, I understand that the way that we got connected may not have been the traditional way of this referral from this person that is well known in my network, but I love what you're building and I'm going to take the time to really dig in and ask questions, and not from a skeptical standpoint, from an objective standpoint. That's what they should be looking for. So that question of, is this fund going to invest in my company or not? Ask early on, hey, what are you all really looking at? When you
Yeah.
do founder evaluations, what are you really basing that on? Is it the quality of school I went to? Is it the connections that I have to X, Y, and Z? And if it's not there, it's not there.
I love that, just like straight up openness, because you're saving everybody so much time when you do that.
Yes.
And I think that is necessary, because the reality is some funds, they look at 6,000 opportunities a year, especially if they're like pre-seed first check, right? And I think what you're alluding to is so valuable. Say that I could keep going. I have a lot more questions that I want to ask, especially around, I think, kind of how founders can become better at being talent identifiers. And I'd love to bring you back for a topic just around that later this year. In the meantime, thank you for joining us and giving us your time generously.
Absolutely. No, thank you, Edgar. And yes, happy to come back and do the talent conversation next time.
Beautiful. I love it. Thank you. I loved my session with Saydeah Howard. I thought that it was pointed. I thought it was confronting. I thought that it goes and has founders really go and evaluate for themselves how they kind of romanticize their own startup, or are overly critical on themselves, or they go and take a look at what they're up to from a lens that might have too many filters. So for her to go and highlight that you got to go and figure out whether the conviction on the other side is biased to go and invest into your company, or to actually go and put the company or the VC firm or the individual investor who you want to go and cut a check for you onto the same footing as you. Am I going to go and get objective advice, or am I going to go and get advice that reinforces the biases that you already have? Beautiful. And I think these are the questions that we have to go and ask ourselves, not all the time, but enough of the time, especially through the fundraising process. Are we going to go and get the people who are investing into our companies that are a match for what the company needs, given who I am as a founder, who we are as a business, what stage that we are at as a company? And I think that is the piece of takeaway that I hope you get for yourself, in addition to all the other wisdom that you went and shared with us today. And in that thought, I leave it to you. Minimize all of the steps that you take to go and look good, and instead focus on what has you perform good or perform exceptionally. I leave it at that. Until the next time.